Well, it gives me great pleasure now to bring on board the Finance Secretary of India, Mr. TV Somanathan, to understand the budget, the messaging from the government, how should markets look at it, and what essentially is the indication from the government. Really appreciate the fact that you could find time the next day after budget to join us live. I mean, I know it's a heck of a busy week for you, and you find some time for us really means a lot to our viewers and to our team. My question, Finance Secretary, is the fact that government has changed taxes on long-term and short-term. What was the thought behind it? Was it to mobilize additional revenue, or was it just to create a balancing act between all asset classes?
Okay, so it's a good question. Policy changes of this kind are not unidimensional. The primary motivation was to simplify the tax structure, which we were told in the feedback that we got during consultations on the budget was exceedingly complicated. There was one rate for listed equity, different rate for listed REITs, different holding period for some things, different holding periods for other things. And there was a widespread request for simplification. So the primary aim here is simplification. And you can see that that has happened in terms of reducing the number of rates, reducing the differences in classification between one kind of asset and another, whether it's 1 year to 2 years to 3 years in some cases. So its simplification is in fact, the primary objective. But increasing revenue collections is also an objective, and particularly in the case of the listed equity space, it is an attempt to do a rationalization, but do it without revenue loss. So there's a slight increase in the case of listed equities for long term, and a substantial increase for short term. For other asset classes such as property, gold, in our opinion, for the majority of taxpayers, this is slightly beneficial, and in aggregate, it is tax neutral. So we do not expect any additional collections of taxation from property, gold, or from those classes of assets. Between listed and unlisted securities, it actually equalizes the rate. It retains a difference of 1 year for listed and 2 years for unlisted. So it's both a simplification and a modest increase in taxation in certain categories.
Finance Secretary, the government has always had a stated objective that they want to increase financialization of assets. Savings should move into more productive assets. Is that stated intent still on, or you think equities as an asset class now are at comfortable levels and you do not want the penetration to increase?
No. There is no change in our stand in terms of not wanting money to flow into equities. But equities are not the only financial class of assets. There are listed equities, there are alternative investment funds, there are fixed deposits, there are insurance policies. There are many forms of financial investment. And there needs to be a balance between the different kinds of financial investment. So our objective is that there must be moderate taxation with simplicity and with minimum complications and minimum chances for evasion and tax arbitrage. So this is the wider objective.
Finance Secretary, but for Indian stock market participants, they have an STT, they have to pay tax on dividend, and now increase in taxation. A lot of taxes, sir.
So please tell me which well-developed capital markets in the world do not have taxation of dividends, which of them do not have taxation of capital gains. Yes, we have a moderate STT, and we have a very moderate rate of capital gains taxation in comparison to the very developed financial markets with whom India is very legitimately happy to compare itself with. So we consider ourselves a world-class capital market. And when I look at world-class capital markets in, say, New York or London or other such well-established financial hubs, I find capital gains taxes are much higher. I find that dividend taxation is universally present. and that they still develop into very thriving financial locations. And they have developed into these locations over an era where they had all these taxes.
Finance Secretary, my next question is that the rate of 12.5%, it's an odd number, sir. But will the number stop here, or this is just an indication? Because 6 months down the line, the next budget is coming. Has a new rate cycle started?
It is not our intention to start any new rate cycle. This is a unification of rates of different asset classes. As I said, it was our calculation that this rate would be broadly neutral for the other asset classes which were on a regime of 20% with indexation. So it was our calculation, particularly for the unlisted property and other assets, that if you remove the indexation benefit, the effective tax was something close to 13 to 14%. We chose to go a little lower for a round number which could be unified with listed securities. So there is no intention to go further.
Finance Secretary, last time when the government moved on long-term and short-term taxes was in 2018 under Mr. Jaitley's leadership, and it has taken almost 5 years before the next move was done. So can I assume that while this move should be looked into a similar kind of an lens, that government has increased taxes, now they will observe it, they would look at the numbers and then perhaps decide on it? They will not be in a hurry?
I don't think I'm being very clear, we are not looking at this as a measure for 6 months. This is the unification that we have wanted to do. We have done it. There's no intention to change this in the short run. Now, why am I saying short run? Because it is not for me to say what will happen in the long run. So many things can happen in the long run which I can't predict. But there's no current intention to go any further.
Real estate sector, Finance Secretary, just about started blossoming. And when the real estate sector which has a multiplier effect, one would say that was there need to change the indexation rules? And again, what was the thought behind it? We just want to understand your thoughts, sir.
The thought was simplification. You see, if you try filing an income tax return and if you have capital gains, you have multiple sections of the form. There is one for things with indexation, some without indexation, some at this rate, some at that rate. This is not what I am saying. This is what we were told by industry. This is what we were told by taxpayer associations, that it's very complicated. And then indexation for each year, you have to do a computation. So its a direction is simplification. Now, frankly, as a mathematical number, 20% of real and 12.5% of nominal are not very different in high return assets. Like, in fact, in most cases of real estate, we have calculated it will be beneficial, because if look, who invests in real estate? If you invest in real estate only for the sake of your own home, then you have a rollover provision which is there. You don't need to pay tax on your real estate gain. You can roll it over into another house. You can do it for values up to 10 crores. So if we are talking about individual middle class investors having a house, they don't even need to pay a tax when they sell their house, because there are rollover provisions through capital gains bonds. There are rollover provisions through buying another property. So that is not what we are talking about. We are talking about people who are looking at it as an investment. If you're looking at it as an investment, then what rate of return do you expect from real estate? I presume you are looking for something more than a fixed deposit. So if a fixed deposit is giving you 7 to 7.5%, I don't think you would buy a property for that rate of return. So you're looking at something which is substantially higher, which is 11%, 12%, 13, 14, 15, 20. Anything above approximately 10%, and if you take inflation at 4 to 5%, 12.5% is not higher than what you would get. But if you're assuming that property will grow at a very low rate, then perhaps the loss of indexation may result in a higher tax than in a 12.5% rate. But otherwise, 12.5% is far lower than 20%. Yes, there is no indexation, but it's 12.5% of a larger gain instead of 20% of a smaller gain. And we have a number of calculations. It's my rough calculation. If you have a rate of return above 10% and definitely above 11%, then you are better off with 12.5 on the nominal than on 20% on the real gain.
Finance Secretary, I'll take the liberty of extending my interview for another 3-4 minutes. My next question, Finance Secretary, is that I just want to capture the message of the government for the market. Can I say that the message for the stock market and the stock market participants is that the reason why long-term taxes and short-term taxes have been changed is largely to simplify the tax structure? The attempt here is not to perhaps increase the cost of transaction in the capital market, and this is no way an indication by the government that there is something wrong with the capital markets in terms of participation and price points. Can I summarize that, sir, as a message?
I would like to put it more in a more nuanced way. The message to the markets is that long-term investments in the share markets are very important for the economy and they continue to be encouraged. They will be taxed moderately as is necessary for every form of income. And there will be less differential between one form of long-term investment and another form of long-term investment between, say, listed and unlisted, say between listed shares and listed REITs, etc. But there is a second issue, which is that there is a marginal signal which is in favor of long-term versus short-term, which is why the short-term rates have gone up more and the STT on derivative transactions has gone up. So there is a sense that we would like to encourage longer-term investment and not so much put emphasis on speculation through derivatives or speculation through short-term trading in the cash market.
The Finance Ministry worried about speculative action and participation in the F&O market. What is your view, sir?
Worried may be too strong a term, but I think the ratio of futures and options trading to cash market trading in India is abnormally high by global standards. And it is, I would say it's a concern. And but however, it is not something that we would like to handle in a heavy-handed manner. Specific measures would be taken by regulators when they feel it is appropriate. But from our side, this is an opportunity to collect a tax on a non-merit activity as we see it.
Finance Secretary, I would like to point out our viewers to the great success story of last couple of years, which is the amount of wealth which has got created in PSU stocks. What were called as the ugly ducklings and backbenchers now are the cheerleaders. The market cap and the kind of respect PSU stocks are commanding, all thanks to good work by the government. This is a time when valuations are at record high, market caps are at record high. Do you think this is a good time for government now to start indirect disinvestment via the OFS route or by the direct stake sale in the market, because market is ripe and large quantities could be digested?
See, the right time to disinvest is something which I think the government will take a very pragmatic view on. If we had listened and done a lot of disinvestment 2 years ago, we would have less money now to disinvest. So the optimal timing is always more apparent with hindsight than in advance. So I don't have too many comments on this. My colleague, Mr. Tuhinkant Pandey, is in charge of this, of timing when we do our disinvestments. And I genuinely don't want to preempt what he would be doing. And you know this very well. You are a market channel. That if I were trying to do something, I wouldn't want to tell you in advance because I would want to get the best value that I can get.
Finance Secretary, my last but one question. The budget has gone down very well, and macro watchers, and including us as ET now, we are calling it a budget for the bond market, and bond markets are delighted. But bond market participants have one question. The numbers for this year are easy to understand. But for next year, how would the fiscal deficit number be met minus the RBI dividend?
We have made a commitment to bring next year's deficit to below 4.5%. That commitment has been made in 2021, reiterated in 2022, reiterated in 2023, reiterated in the interim budget in 2024, and reiterated now. And now we are just 6 months away from the budget for 2025-26. So that should reflect our seriousness in getting there, and our track record is that every time we have progressively moved closer to that number. So let me tell you that we are committed to bringing the deficit below 4.5% for the next financial year. How will we do it? There are multiple ways that we can do it. There are certain items of expenditure that are flexible. Yes, the RBI dividend is a one-off, but it's not necessarily something that will shrink completely next year from its current levels. It may shrink, but if it does, we have other sources by which we are expecting buoyant dividends from the public sector and public sector banks. We have certain parts of our expenditure which are controllable. For example, we have certain discretionary expenditures on the capital side, the loans we give to state governments. Those are flexible. We can adjust them to the requirements, and therefore there is enough flexibility for us to attain the objective of fiscal deficit below 4.5% of GDP, and I think therefore there is no reason for doubt on that objective.
Wrap the discussion by saying that we at TT now sincerely feel that the budget estimates are conservative and there could be a big upside which could come on the tax collection side, and the fact that this year we are in for a good monsoon and inflation is coming under control, so the macros will ensure that we are in for positive surprise. Will that be a fair assessment on my part?
Numbers are conservative. Well, possibly, but not too much. I think we have given a fairly large middle class tax cut on the new system, and the new system, by the way, is now the majority system, as we are seeing in the returns that are coming in. So there is a 17,500 rupee per person tax cut. There is a tax cut on gold in terms of customs duty. And so our estimate, as reflected in the budget speech, is minus 7,000 crores on the tax front. So is it conservative? Time will tell. But we are certainly confident of reaching our target of 4.9%. Will we do better than that? Let's see.
Secretary, compliments to you, your team, for putting such a strong budget forward, lead to leap, a budget which in a sense has ensured that the growth momentum remains intact, economy remains on a strong wicket, and this budget in a sense will ensure that the multiplier effect kicks in. Thank you for your time, truly grateful for that.